Hi, good day to all. Welcome to Trade the Markets Like a Pro, a series of educational videos. Today we'll be covering Module 4 Trading with Key Reversal Japanese Candlestick Patterns. So, as you all could recall, from Module 1 to Module 3, we touched about the basics of market cycle, trend analysis, as well as how do we depict support and resistances, as well as their usage in terms of trading the markets, such as the stock indices, stocks, as well and foreign exchange market. So before we start on this module, let's take a look at the disclaimer slides first. All right. So as you know that in my last module 3, where we actually share with you all how do we actually draw support and resistance level on a price chart or a technical analysis chart on our platform. And the next key thing that most of you come on mind over here is that we need to have a kind of a positive element to indicate to us that there will be a chance of a rebound at the support level. As on contrary, there will there must be some signs of negative elements to indicate that hey, price action of a particular stock indices or a forex pair has reached a ceiling, which is the resistance, and there is a high chance that it will start to retreat from that level or zone. So in order for us to detect such price behavior or a change in sentiment, we got to know how to spot what I call key reversal Japanese candlestick patterns that will help us in this aspect of trading. So basically, in a nutshell, it's been established in the 18th century, even way before Charles Dow created the Western bar chart or the Western form of technical analysis using the down theory. So it's actually Japanese candlesticks together with the silver key reversal candlestick pattern has been established by a legendary Japanese rice trader called Mr. Homa. And the purpose of this reversal Japanese candlestick pattern is to understand or and to pinpoint a change in market participant sentiment. And because humans' behavior never change, and this particular or this several set of key reversal pattern that I will share with you all later tends to be repetitive in nature. All right. The next key thing about key reversal Japanese candlestick pattern is definitely based on the order of higher time frames. Similar that when you're using support and resistance on the reverse time frame chart. So same aspect of it on this reversal candlestick patterns. Higher time frame chart will tend to have more significant impact on forecasting potential future direction of price actions. Example, a hammer, which is termed as a daily bullish reversal candlestick pattern, if it's being detected on a daily chart or formed on a daily chart, this pattern will have more significance than an hourly hammer that only take 1 hour of price action to form that is on the hourly chart. And also to candlestick pattern do not use as a standalone basis. In fact, technical analysis, we're talking about in fact indicators or Fibonacci retracement, Fibonacci projection level, all these tools of or arsenal of technical analysis tools, we need to be used in conjunction with trend analysis as well as the Wyckoff method that I share with you all in module the first three module, and together with graphical support and resistance level to actually improve its effectiveness. So later I'll share with you an example how do we use reversal candlestick pattern together with trend analysis and support and resistance level. And the purpose of we being as traders, if we are able to detect such key reversal candlestick pattern, we'll be able to fine-tune trading setups, i.e., it can be used as a bullish signal or a bearish signal after such price action of the instrument that we are monitoring reach at or near the support level or zone or at or near the resistance level or zone. Alright, so let us start with the bullish reversal candlestick pattern first. So in fact, bullish reversal candlestick pattern that are being classified according to three categories: single, double, and triple. So the whole world of trading in terms of candlestick pattern, there are actually close to about 20 to 30 of them. But I'm going to share with you all, in my example, these are the one that in my own experience tends to be more effective and tends to be more useful in terms of trading the markets using technical analysis. So the first candlestick, which is a single candlestick pattern that I like to share, will be a hammer, a bullish hammer. So in order to see a bullish hammer, the first thing is we need to see a clear sign of prior down movement in price action. Like I say, candlestick pattern can be found on the daily chart, the hourly chart, the 15-minute chart, or the 4-hour chart. That means IA, if we open up any time frame chart, the first thing I will see is a series of lower lows on the chart itself. That means a clear down pattern before a bullish hammer that is being depicted. All right, so how does a bullish hammer look? It's actually a small little body where the close and open is very similar to one another in terms of the price action, and we have a long tail at the bottom. All right, so very similar to a hammer is like a bullish dragonfly doji, we call it in short, where the close and the open are the same level. But the key psychology aspect is still the same, which is the long wick at the bottom. So basically, why this candle is bullish in terms of psychology, it means that it traveled to the low in the intraday basis, if you look at the daily chart. But however, as the trading progresses throughout the day, price action managed to shoot up and close near the high, which indicate to us there's a kind of a change in sentiment from negative to positive on any particular session that we are looking at on this hammer pattern. And another one that is a bullish as well is the inverted. We call it the inverted hammer or a bullish gravestone doji. Okay, then now let's move on to the double bullish candlestick pattern. So this required two candlesticks to form before a bullish reversal pattern take shape. We call it a double. So what does it mean over here is that there are actually one, two, three, four, five of them, which is pretty key. Is first one will be the bullish engulfing. That means we start to see a series of down candle that is trading lower, shaping lower lows, and we start to see a small body candle, and the second candle will be a large green candle that actually engulfs the body of the small candle. All right, so what it means that initially it actually gap down first. The opening price or the opening candle, the opening level of this green candle is actually lower than the closing candle of this small little red body, and towards the end of the session it managed to actually close above the body of the bearish candle, pardon me, which is the opening price of this small little body. So it immediately kind of eat up the small red candle, the red bearish candle. So it's something like a big bull eating up a little bear in terms of bearish engulfing. And pretty similar will be the bullish piercing. So this bullish piercing over here, what it means that instead of covering the entire body of the prior bearish candle, it actually closes slightly above the midpoint of the bearish candle. Then goes for the bearish harami. So bearish harami is a small little green body that is seen after the bearish candle. All right, then you have a bearish harami cross similar to this pardon me, bullish harami cross similar to a bullish harami cross, which is this bullish harami is a small little body, whereas the bullish harami cross is just a doji candle. So what it means that over here is that previously we start to see a long red candle bearish, but after that you start to see a appearance of a small little body indicating that it's formed within the body of the red candle. That means there's no gap down, it formed within the body, indicating to us that hey, potentially the prior we call it bearish pressure seems to be exhausted by this formation of this small body, similar to the one that we see in this doji, where actually the difference between a small body and a doji is that the open and the close are similar level. And the next one over here is that yes, we one white soldier, we still need to see a series of clear downward price movement of lower lows. Then the next key thing over here is that it's a kind of a V-shaped victory, stand for victory, where the opening price of the bullish candle actually gap up from the red candle and it closes above the high of the upper wick or the high of the bearish candle over here. Now, moving on will be the triple candlestick pattern in terms of bullish, still bullish reversal. So this actually takes three candlesticks to form from here. So what we could see over here is that firstly, we need to have three candlestick. This is the first candle, second candle, and the third candle. So what it means over here is that the second candle gaps down with a small body of the first candle, and the color does not matter. And we're talking about sometime about this gap down, as we know that let me touch on, based on my experience, you all know that foreign exchange market tends to trade like a 24 days, in a way that 24 hours days from Monday to Friday, so very hard for us to actually see a kind of a gap down session unless there is a kind of a during the Asia opening hours on Monday or gap up. So for foreign exchange market, right, usually we tend to be a bit more less stringent about this gap down. It can actually open at the similar closing price of the red candle. Okay, for the okay, so pardon me, yeah, actually, yeah, it can open at the same price of the red candle. That means we're talking about the this bullish morning star for the foreign exchange market. So then the third candle is that the closing price of the second candle, most importantly, is over here, is that it must close into the body of the red candle. Okay, indicating to us that the prior bearish pressure has started to be negated by this candlestick 2 and candlestick 3. So it's, think of it, it's like something like a U shape. It's a bit like a kind of a pointed U shape price action on the bullish morning star. So similar on the bullish morning doji star. So except for candlestick 2, a small little body, this being kind of replaced by a doji, where the opening price and the closing price for that session are similar levels, but the impact is similar as well. Price action like a pointed U shape. All right. Now I have touched on the various key bullish reversal candlestick pattern from single, double to triple. Now let on move on to the bearish reversal candlestick pattern. So same in a sets of three: single, double, and triple. So firstly, in order for a candlestick to be bearish, to be a bearish reversal pattern, you need to see a series of clear price action movement first. That means higher highs. Okay, be it on the daily chart, weekly chart, monthly chart, hourly chart, 15-minute chart, or even the 5-minute chart, a clear upward movement. Then thereafter, if you spot a key that if you spot a bearish with a key reversal candlestick pattern, bearish one, so that can be determined as termed as a key reversal bearish candlestick pattern. So what we could see over here, the most simple one will be the shooting star, a long wick at the top, followed by the close and the opening are pretty similar, a small little body near the lows. So in terms of sentiment, why is it bearish? Because of the sudden intraday or intra-session push up to the high, but it couldn't maintain that upside momentum and it started to close at the session low. All right, so can you see, if you could understand, that it's a kind of an intermediate or an immediate change of sentiment from initially intraday bullish to towards the end it became pretty negative. So the one that is similar to a shooting star is like a gravestone doji, where bearish gravestone doji, pardon me, whereas the opening level and the closing level are similar. And invertedly of a shooting star will be this bearish hanging man, small little body as well, and similar to the bearish hanging man is this bearish dragonfly doji. Okay, now moving on to this bearish reversal candlestick pattern, a double two candlesticks, so it requires two candlesticks to form. So all this psychology is just the reverse from the double bullish reversal candlestick pattern. So instead of a bullish engulfing, now we start to see a bearish engulfing. Prior up movement in the price action first, higher high, then we start to see a long or a kind of a larger red candle, bearish candle body eating up a small little bullish candle on this on the formation of this second candle from here. Then we have this dark cloud cover where we have a gap up and where the price action of this bearish candle, the red candle, closes below the midpoint of the prior bullish candle. And right now, bearish harami indicating to us that the previous uh, bullish bullish pressure as seen in this larger uh, positive green candle has started to subside or negated by the formation of a small little body, bearish body, inside the body of the prior bullish candle. And very similarly, bearish harami cross, instead of a small body, it actually took in the shape of a doji where the opening level and the closing level are the same. And this is will be one black crow. So this is some like an inverted V shape where price action start to see a series of high. Then thereafter, right, the kind of the opening price gap down from the prior bullish candle and it actually closes below the low of the prior bullish candle. So that's a one black crow. Now moving on to the pattern, which is the triple bearish candle, triple bearish reversal candlestick pattern. This is the inverse of the morning star, or the bullish morning star. We call it bearish evening star. So same thing, it's like a inverted U shape, okay, inverted pointed U shape. So a series of candle that is shaping upwards, clear movement of higher high, then thereafter it start to form a small little red body. Then it's the third candle actually closes into the body of the first bullish candle. So same thing as well. Typically, in theory, we start to say that the second candle must have a gap up from the first candle. That means the opening price must be above the closing price of the first candle. But the opening price can be similar as well to the closing price of this first bullish candle. Is for foreign exchange prices. So as I explained earlier on, is that because the foreign exchange market from Monday to Friday is more like a 24 hours market. The only thing that we can see gap up or gap down is on Asia, Monday Asia morning tends that is the usual case. Okay, so throughout the session, most of the time we seldom see any potential gap up or gap down in the major traded forex exchange pairs. So moving on to the this bearish evening doji star, also similar psychology as well as the bearish evening star over here, is that instead of the second candle being a small little body, now the second candle took the form of a doji, where the similar pardon me, where the closing price and the opening price are the same level. So in terms of analogy, the price action is still the same. It's like a inverted narrow U-shaped price action. All right, now so now I've covered the key aspects, or the various what we call it significant key reversal candlestick pattern from bullish to bearish. So now let us pierce together of what we have learned so far from module 1 up to module 4, which is this module. All right, so as we could say that if we were to trade with the trend, okay, let's look at this example over here using this iShares Philadelphia Semiconductor ETF, SOX in short. The first thing to do is to identify the trend. All right, so we could see that we have it started to trade a series of higher high and higher low. Okay, so we know the trend is up. So if you are trading with the trend, the next key step over here is that, hey, we want to trade with this trend. That means we don't want to have to take a counter trend trading strategy. Since this is an uptrend, we will actually look for more bullish opportunity. Then the next key thing is, where do we look for the bullish opportunity? Okay, is to find the support level or the support zone. So if I could draw a horizontal support, pardon, horizontal, ascending trend line, taking from the lows of March this year, okay, one time, two time, three time. All right, so we have the support level close to at this area here. Okay, so the next key step over here is that we know that the price action has started to do a pullback. That means we start to see a series of lower candles, okay, that has lower lows. So the next key step over here is that we know that it's coming very close to a support level. Okay, so the next key step over here is that we want to identify or wait for the appearance of a bullish reversal candlestick, which is at this support level or near this support level. All right, so now let's patiently wait. Hey, do you notice that we managed to spot a one white soldier over here? So what is telling us over here is that price action pullback now at this support level. In terms of probability, based on the appearance of this one white soldier and the trend is up, there is a higher chance that a potential up move may occur after the appearance of this one white soldier. So now the next key step is that I could initiate a positive trading setup opportunity. So for every trading setup opportunity, we need to have a stop loss level and as well as a take profit level or an exit level to calculate the potential reward risk ratio. So you could see over here that we know that this is something like a make or break level or zone. That means price action start to pull back at the support formation of this one white soldier. And since this is a positive key reversal candlestick pattern or a bullish key reversal candlestick pattern as per se, we want price action of these stocks to go up instead of come down. So as we know in trading, everything is based on probability, right? So there is still a small probability of the price coming down. But this is not to be afraid. Why? Because we already know that if the price starts to come down, I'm initiating at a make or break level. That means we could get out fast. That means we need to place a stop loss level on a certain ticks or bits below this support line. So in my next other module, I'll share with you all, there's actually one method to actually to calculate what is the stop loss level based on the current volatility of the instrument that we want to trade. Okay, so let's say per se that this will be the exit target, okay, and this will be the stop loss, okay, certain ticks below the support level. So if you look at, if you calculate the reward risk ratio based on the next price action over here, so it seems to me that the expected risk versus the expected reward, the reward is more than the risk. So that is a good, I would say, is a very called good trading setup opportunity. All right, now moving on to an example where I share with you all trading with bearish reversal candlestick pattern. Okay, now I'm using the 1 hour chart. So I share with you all, reversal candlestick pattern can also be seen on the lower time frame chart like the hourly chart as well. Okay, so now this is the euro dollar FX market. So firstly, we got to identify the trend first. Higher, pardon me. If you look at it, what is this? Lower high, okay, followed by a series of lower low. Okay, so for sure this is what I call a downtrend. So if we are trading in a downtrend, we want to trade with the trend. So that's why, i.e., we are looking out for bearish opportunity near or at the resistance. So the next thing is to identify the resistance level or find the resistance. So I could see one time, two time, three times. So this is a descending trend line resistance. Okay, over here. So the key thing over here is that a price. So we now what we got to do is that we got to wait for the price to actually come close to the resistance, like we see over here. And you realize that what do we see over here is the wait for the appearance of a bearish reversal candlestick. So we could see this is a shooting star. All right, so the next step is to initiate a trading setup opportunity, bearish one. That means from here, since this is the resistance level, this level here is like a make or break level. That means in terms of probability, since the appearance of this bearish reversal candlestick, the probability is actually skewing for the price action to actually come down to actually retest the previous low over here. So nevertheless, everything in trading in terms of probability, if we are wrong, we know that, hey, we got to get out fast at this level. So i.e., that means our stop loss level is actually very, very close right now, which means our expected risk will be lesser rather than if you were to trade when price action has really starts to come down way from the resistance level. Okay, so this is what I mean. So this will be the stop loss level. So not to worry, in my next video I will share with you, in my next few videos I will share with you how to actually calculate a proper stop loss based on the current volatility of the instrument that we are monitoring or trading. And this will be my support level. The next, we call it the intermediate support, which is the last swing low. That will be my exit target. So in terms of reward risk ratio, it's actually pretty attractive based on this trading setup. So as you could see, price action at the open, and after that, thereafter is indeed collapse and went to shape lower lows on this 1 hour euro dollar chart. Okay, so I've covered module 4 of this several key reversal candlestick pattern that we could actually help us to actually formulate a pretty simple trading setup plan or opportunity by allowing us to pinpoint the turning point at the support zone level or at the resistance level or zone. So thank you for your time, and I see you all next in my next education video.